Hey guys, and welcome back to the channel. Today I want to talk to you about Palantir Technologies. I'm sure if you follow any investing forum, I'd say you've heard about this company. It's a pretty hyped company, and initially I didn't really look at it because it was hyped and I tend to stay away from hyped companies. However, I do think that this company is onto something, and yeah, I have a whole thesis behind it, and I also have a small position in this company right now. And yeah, I just want to go over this investment with you guys and yeah, see how it looks. So first I'm gonna tell you a bit about the company and I go a little bit more in depth about what they have recently achieved, and afterwards I will show you my valuation for this company. So let's start. So Palantir has three products, solutions you might say. First one is Palantir Gotham, which well, based on the name you might have an idea of what it does. It at least sounds like it's helpful to catching bad guys, just to say it like that. Very Batman and stuff like that. But next one is Palantir Foundry, and the last one is Palantir Apollo. And I'm pretty sure that this doesn't say a lot if you just see these names, but these are all enterprise data solutions, and I think that's a very interesting concept. However, they have a few examples that show you what they actually do with it, and we'll get to that in a bit. Here you see in their investors presentation sheet, they mentioned that congratulations to the U.S. Justice Department on its settlement with Purdue Pharma and fight against the opioid epidemic in America, and supporting the Department of Justice with Palantir Gotham. So that is the one thing that it does. Congratulations to the World Food Program on its Nobel Peace Prize, supporting World Food Program with Palantir Foundry. Again, probably not something you imagine that they could help with, but yeah, something they help with. In awe of and grateful for the service of our special operators, October's rescue is yet another amazing accomplishment. One that often goes unrecognized, supporting special operators. They didn't mention which software they use for this one, but again, something that they do. In general, when it comes to data-driven SaaS solutions or enterprise solutions, I think that the amount of customer potential that it has, I think, is insane, and I think that is often overlooked. I think it is almost impossible for us that are not working in a company to see what kind of potential it has in certain industries. Here we get a little bit of an insight like artificial intelligence, automotive, auto racing, case management, cyber, defense, financial compliance. Think about banks and stuff, insurance, yay, insurance companies, intelligence, law enforcement, manufacturing, sales and revenue. So we're talking more about sales and stuff, mergers and acquisitions. Again, potentially, well, this could actually just help any company potentially who wants to merge and acquire a company. But I think that the solutions that they have right now and the industries that they have solutions for, I think it could increase in the next few years, that they discover something, they make a new product, and yeah, it can offer solutions in a different area. Something else I really like from the sheet is an energy super major deployed our ERP suite in hours. Within 2 weeks, they generated a 57 million of cash savings and expected to generate $1 billion on an annualized basis. Why is this interesting? So I think something interesting about stuff like this is that they have the ability to reduce costs for companies. And while you may think, okay, it's kind of subjective, but in this case, and I think in other cases as well, you can see how much money they actually save. And it's expected to generate a 1 billion on an annualized basis in savings. Yeah, that's insane. And then you can think, okay, how much money are you willing to pay for software that saves you this amount of money? And I think this could vary a lot, but in general, if you would pay like $500 million for the software and you get a 1 billion savings in return, then it's still a good investment from a customer perspective. Obviously, I don't think this contract is 500 million right now, but the potential is there. And this is obviously just for a energy super major, but it could be that it's for other customers as well. It's going to be saving so much costs in the long term for them. And yeah, once you have that proof, then it could very well be offering a lot of potential for basically all customers out there. So I think this is a very interesting part as well. Then to go to the summary of their most recent quarterly earnings. So they had a revenue in the third quarter of about $290 million. It's up 52% year over year. They increased their full year guidance to 44% year over year increase. New contracts in third quarter include US Army, $91 million, Institutes of Health, $36 million, and $300 million renewal with aerospace customer. This one is particularly interesting because it's a bit vague. From reading all the sheets, I do realize that what I initially thought that this would be the Air Force, the US Air Force. That's not the case because this does not fall under the commercial revenue increases. Or it does not fall under the government revenue increases, sorry, so it's potentially commercial. And they had a sheet and they linked to a video there, and in that link somebody or a spokesman from Airbus was talking, so it could be that this is Boeing or Airbus in that regard. Obviously it could also be any airline or stuff like that that needs help controlling costs right now, and I believe that offers a lot of potential if you think about this market. And obviously there's a lot of money there as well, and especially if it offers a cost saving solution of like $1 billion as we've seen with energy, I think this could be a very big potential in that market. So yeah, we'll have to wait and see, of course, but it's a nice start. In Q3 2020, our government business grew 68% year over year. So this is where I saw, okay, it's the US Army Research, and there's with the National Center of Advancing Translational Sciences. So if the aerospace customer was from the government, so US Air Force, for example, I would assume that it would be listed here. So I think therefore that it's commercial, and that, well, I do believe that this government business is or has a lot of potential. I believe that if they grow that big in the commercial segment, I think that is very lucrative for the long term. So something else I liked is, and this might be a little bit small, so I'll go over it real quick. We accelerated growth in all three phases of our business model. So they have an acquire phase where they acquire new customers, and here you see that it almost doubled in the recent quarter. They have an expand phase, which is, okay, you have acquired a customer, then we're going to expand it. Probably this is a little bit more intensive from a overhead perspective for Palantir. Like, I believe that they will have professional services and people working for projects and engineers and stuff like that going to that customer to install that phase if they want to use the software for more stuff. And afterwards you have a scale phase, and I think this scale phase is probably the most interesting one. Sure, these few years we want to look at the acquire phase, we want to see them achieving as much customers as possible, but I think once they have achieved those customers, the scale phase is going to be the most appealing one, because once you start scaling within a customer, you mostly collect more revenue while your costs are not increasing with a similar amount, and that is why that is very appealing, at least to me. And something else that they mentioned here, in addition to customers accounting for by our three-phase model, revenue from customers acquired in the 9 months ended September 30, 2020 grew by 175% year over year. So their recent acquired customers already grew revenue as well. And yeah, obviously these numbers are insane, but we'll have to see how that pans out, of course. So a few takeaways from this is that first, it's a very sticky business. Like you are working with enterprise and software as a service solutions. So if you want to keep using the software, you will have to keep paying every year. or many years if they have some kind of payment agreement, of course. But that's kind of sticky. Once you are within the business, especially in governments and stuff, it will be very hard to get out of there. So I like that about this type of business. It's a scalable business. I'm talking about the third phase here. I think that part is going to be the most lucrative of all parts. And I think we have seen recently how the scalable business can help Palantir, but I think we haven't seen, I think we've only seen a small part of what is to come. So that's going to be very interesting. Data driven, like I was looking for a company that was data driven in the sense that I have experience in my day-to-day life with data tech companies. I work for one, and I believe that is a very lucrative business, but it's very hard to model a valuation against. But regardless, I think this one has a lot of potential. So I really like that three-step growth model, the way they defined it, and I think thinking about that and thinking about the fact that the scalable business part, scalable growth part, is the last part, I think we can see significant growth in the future. And obviously this is a high growth business and a very hyped one, so it's going to be very risky for my type of investments in that regard, because I'm usually not one to follow hype. However, obviously I really like the story of this business, and as you guys know, my investments should have two parts. I need to like the story and I need to like the valuation. So while most people in high growth or even growth businesses do not do anything in regards to valuation, I did make a model for it. So let's get to that one. In regards to the valuation, I have several steps before I come to my discounted cash flow method. First, I need to put in the growth or the estimated revenue costs and other costs numbers, and that's what I listed here. And then I have these growth rates. So these growth rates are pretty high, not as high as Tesla, for example, but they're pretty high. But I believe that this kind of business will have their costs of grow at a slower pace than their revenue, and I think that is what will make a difference 10 years from now. Because the moment your other costs are slowing at a or are growing at a slower rate than your revenue, whatever revenue you collect is going to affect your bottom line, and that is going to be very lucrative. So the difference could basically be full profit. So is this going to be correct? I don't think so. Obviously the growth rates fluctuate. Growth rates are higher right now. They could potentially be higher in the future. I think for this type of business, I think these growth rates are reasonable, but we'll have to see. So what I did is I listed the revenue growth numbers, and with this growth number, I expect the revenue to be $31 billion in 2030, so 10 years from now, which is an insane growth rate, I must say, but it's not at all unlikely in that regard. So the cost of revenue will grow at a similar pace. Usually that's the case. They could be that they are able to increase their gross margins, which would mean that the cost of revenue will slow or grow at a slower pace. But to be on the safe side, I'm gonna assume it's gonna grow at the same rate. And then we have other costs, which is G&A, research and development, and all that. I believe that to still grow significantly, if they grow at this pace, but I believe it to be significantly lower than the revenue growth. So what would that mean to the EBITDA? Because that's basically what we're calculating here. And you might be surprised that the EBITDA is almost similar to the operational cash flow. So, and this type of business, I don't expect a lot of capital expenditures. So I'm going to assume that this is going to be the free cash flow in future calculations. But I expect the EBITDA, which is the revenue minus cost of revenue minus other costs, to be negative for the next 3 years. Yeah. Next up, I believe that once it starts scaling, I believe it's going to grow significantly. And that would mean that 10 years from now, I believe that the free cash flow could potentially be 10 billion. Is that insane if you currently have a 1 billion revenue? Sure. Yeah, but we've seen, if you look at the previous 3 years of their cost and you take all the exceptions out that are one-off, then you would see that actually their other costs haven't really been growing at this rate. They have been growing at a slower rate. Revenue has been growing at a slower pace than this as well, like a little bit slower. But with their scalable part, I think that once they have acquired these customers, within those customers they can grow significantly. So I think that this for the next 10 years is reasonable. Taking that into account, we can start to calculate the cash flow, the discounted cash flow method, and we can use a discount rate of 7%, which is about the market rate of return, the expected market rate of return if you invest in an all-world fund, basically. That's why I use this discount. And yeah, with this free cash flow, this would be the present value, and that would mean that yeah, in 10 years you would have generated about $25.5 billion, I should say, so this is not correct, I'm sorry for that, in free cash flow, and that would be the present value of $14 billion. Right now, the company is trading at 34 billion market cap. I had the old sheet for this one, so it's 34 billion, so it's significantly lower. But obviously, 10 years from now, you can still sell the company. And the terminal value, so when I would sell the company, I believe that the price to free cash flow rate could be 15. I think that this type of business is going to be very much worth paying a premium over because of the way it generates cash flows. So that would mean that the future price of this company would be $157 billion, and that would mean that the present value with a discount rate of 7% per year would be about $80 billion. So that $80 billion added with the present value of the 10 years of free cash flow would come to a 94 billion calculated market cap with these growth numbers, and the market cap right now is 34 billion, so this is incorrect, but right now it's 34 billion, and that would leave us with an undervaluation by about 63%. Obviously these are all estimates, so I would be very surprised if they were even remotely correct, but it does give me some reasonable insight into the future. And since I am pretty generous with these growth estimates, I'd say that once this company reaches about, let's say, 100 billion market cap in the next few years, I will reconsider if I still want to hold this position. If it drops, since I really like the position and I would like to see it drop to about the $10 range, I would acquire more shares. But since we don't know if it's still going to drop, I made sure to open a small position and see how this type of investment will fit in my portfolio. So I mostly like the story. I also was able to make a valuation, and those combined leave me with my investment thesis for Palantir. That's it for today, guys. Hope you guys enjoyed it. If you like this type of videos, please leave a like and let me know down in the comments below. And I would also be curious to know what you guys think about Palantir Technologies. Thank you guys for watching, and see you guys in the next video.